Hello and welcome back to Bunnex Investment Group, and today we are going to be talking about an interesting concept of using moving averages only that will actually help you determine bias in your trading. It must be noted that there is no 100% working system and that all that will be mentioned in this video works on a probability. But before we jump into the whole video, make sure you hit that subscribe button and check the notification bell icon if you haven't done so that you'll be notified each and every time I upload a new video. Please check out our free Telegram channel where we share free signals, trading advice, as well as support. The link is right below. So here is what we'll go through in this video. We'll talk about the indicators that are needed in this system, or in this hack as we termed it, the crossover principle, then examples from the real charts, then how to use it in your trading. Basically, we'll now share how you can incorporate it or make it a strategy in your trading. So the first thing that we are going to do is to talk about the indicators that we need. We are going to be using indicators in using this hack, and it is widely known that indicators are lagging from real price movements, but if used properly, they may enable us to get the bias of the future with a higher probability. So the first pullback hack in particular uses these indicators, which are 1, the exponential moving average 5, EMA 13, EMA 50, EMA 200, and last but not least, the EMA 800. So I would love to have these as 5 in yellow, 13 in red, 50 in sky blue, 200 in white, and 800 in dark blue. So here is the crossover principle, and for us to proceed and understand each and every step that we are going to talk about, we need to make sure we understand the principle, and the principle states that when a smaller period EMA crosses a higher period EMA, we expect the market to pull back to the higher period EMA. By pulling back to the higher period EMA, we don't exactly mean to touch it, but to pull back to the zone of the higher period EMA. So for example, when 200 EMA crosses 800 EMA, we expect the market to pull back. Actually, I made a mistake, to 800 EMA. So if 13 crosses 50, we expect the market to come back to 50. If 50 crosses 200, we expect the market to come back to the zone of 200. So as mentioned earlier, this works on a probability. We can't expect to see it exactly like this in all the markets and all the time. So let's jump over the examples and explain what we mean by the crossover principle. So as you can see, this is a snippet from USD against CHF. The first thing that we can see from this thing is at this point we saw that there was 1350 cross, 13 in red and 50 in sky blue. There was 1350 cross, and from our principle we can see that the market came back to the zone of the 50 EMA, and it took off. Then after that we also saw a 250 crossover here, right? After that crossover, the market came back to the higher period EMA, in this case 200 EMA, and it also got back to the region of that EMA. So the principle states that whenever a smaller EMA crosses a bigger EMA, we expect the market to come back to the bigger EMA. Basically that. Then here's another example on USD against CAD. This it doesn't matter on which time frame you are looking at. On H1 it happens, on M15 it happens, on daily time frame it happens. It all depends on the type of trader you are. If you are a swing trader, definitely you would like to see these hacks on higher time frame. Then here we had a 1350 crossover at this point. Then the market came back to the region of the 50 EMA, and after that we can see that we had another 250 crossover, and in the future we actually expected the market to come back to the 200 EMA. And one thing you have to watch out against is you have to validate one cross at a time and its retracement or its pullback. It's one crossover and one pullback. Don't use it several or multiple times. Then here is another example on GBP against CHF. We can see that there was a 50 200 EMA crossover. Then after that the market came back to the 200 EMA region and it went down. Then here we had another type of crossover. Yes, of course, we had the 1350 crossover, right, which was then cancelled at this point, since we had a crossover of the 200 800 crossover. After that 200 800 crossover, the market came back to the bigger EMA, which is the 800. So basically that is what you'll be looking for. The first thing is to see a clear crossover. After that you expect to see the market coming back to the higher period EMA. So watch till the end of the video so that I will show you how you can actually incorporate it in your trading, incorporate it in your, or use it as a strategy. Then this is gold, and on gold we had a 250 crossover here. After that 250 crossover, we had the market coming back or pulling back to the 200 EMA, which is the higher period moving average. So here's how you can use this as a trading strategy, and knowing that the market is going to pull back to a certain zone gives you a short-term bias. So basically knowing that we had a crossover and we are going to retrace or to pull back to this zone will actually give you a bias within the market. So to use the bias, you need to have a zone of support or resistance to anticipate the reversal of the market. What do we mean? Let's go on back on our examples so that it will be right. At this point you can see that we had 50-200 crossover, but the now the valid crossover was now the 200-800 because it was the last crossover amongst all these. So the first thing that you need to do is see this crossover and anticipate where the market is going to go. So this was all future play. We didn't see this part when this was in play. So after the 200-800 crossover, the market went down and we expected it to pull back to the 800 EMA. What we now need in this play, or while this is happening, we have to expect to see the market coming back to the 800 EMA. But the exact zone can be actually determined from the left side. As you can see at this point, the market was in play, and the only resistance or the only zone of supply in this zone of the 800 EMA was going to be derived from this point. This is where we were going to derive this zone of supply and actually protrude it into the future. So the market actually came to retest this zone of supply. This is the same as you can see, at this point we had a 200 EMA, 200 EMA and 50 crossover, and we were anticipating to see the market coming back to the 200 EMA region and deriving our zone of demand or our support zone. We could derive it from this point. This is where we could derive it, and the market coming back to this zone and looking for a setup within this zone was going to be beneficial to us. So that's basically how you can use it. You have to see the crossover. After seeing that crossover, you anticipate to see the market pulling back to the higher period EMA and try to look for support or resistance within the region of the higher period EMA to anticipate where the market reversal will actually take place. So that's basically how this hack works. And on that note, we come to the end of our today's video. Don't forget to subscribe and share with someone. Thank you for watching.